The US stock market is breaking records. The S&P 500, Nasdaq, and Dow Jones are all sitting at historic highs. Financial news anchors are smiling. Investors are confident. Some are even convinced the good times will last forever. But history whispers a different story. And right now, the whispers are getting louder. When markets are euphoric, when retail investors pour in, and when corporate insiders quietly sell billions of dollars worth of stock, that's when the danger is greatest. In this video, we'll break down why many analysts, fund managers, and even legendary investors believe a historic market correction is coming. We're talking about the possibility of a 40–50% market decline, a drop that would erase trillions in wealth and shock even seasoned investors. We'll cover the subtle but clear warning signs in today's market. Why corporate insiders, the people running America's biggest companies, are selling their own shares. Key macroeconomic pressures that could trigger a crash. And what steps you can take to protect yourself before it's too late. A quick look back. Before we focus on today, let's take a quick look back. Every major market collapse, 1929, 2000, 2008, shared common warning signs. Excessive optimism. The belief that this time is different. Extreme valuations, prices far beyond the underlying value of businesses. Insider selling, executives cashing out while public investors buy in. High leverage, too much borrowed money in the system. In 1929, ordinary people took out loans to buy stocks. In 2000, any company with a .com in its name could raise millions overnight. In 2008, homeowners and banks piled into risky mortgages. Each time, the crash didn't happen out of nowhere. The signs were there, but most people ignored them. Today's red flags, the parallels between past crashes and today's market, are hard to ignore. 1 pound extreme valuations. The Shiller-Cape ratio is near levels seen only before the crashes of 1929 and 2000. Price-to-earnings ratios for some tech companies are triple their historical averages. Market cap to GDP, also known as the Buffett indicator, is well above 200%, suggesting the market is overvalued by historical standards. 2. Insider selling. Over the past 12 months, corporate insiders have sold tens of billions of dollars in stock while making very few purchases. This includes CEOs, CFOs, and board members, the very people with the best insight into their company's future. Insider selling is not illegal or inherently bad, but when it happens at these levels during a market peak, it's a red flag. 3. Concentrated market gains. A handful of mega-cap tech stocks are driving the majority of market returns. This concentration mirrors the late stages of the dot-com bubble, when a small group of tech names propped up the indexes. If those leaders stumble, the entire market could follow. 4. Record debt levels. US household debt is at an all-time high. Credit card balances have surpassed $1.1 trillion, with interest rates above 20% for many borrowers. The US government's national debt exceeds $36 trillion, and interest payments alone are becoming one of the largest federal expenses. 5. Yield curve inversion. The US Treasury yield curve has been inverted for over a year. An inverted yield curve has preceded every US recession in modern history. While not a perfect timing tool, it's one of the most reliable long-term warning signals. Buffett's quiet warning. Warren Buffett, one of the world's most successful investors, is not making bold predictions on TV. But his actions are speaking volumes. Massive cash position, Berkshire Hathaway is holding over $340 billion in cash and short-term U.S. Treasury bills. Net seller of stocks. For 10 consecutive quarters, Berkshire has sold more stock than it's bought, totaling over $170 billion in net sales. Selective buying. Instead of chasing high-flying U.S. tech stocks, Buffett has made measured investments in Japanese trading companies, diversified businesses with stable earnings. While Buffett is not calling for a crash outright, the fact that he's holding record amounts of cash suggests he sees few bargains in today's market. The psychology of euphoria. Market crashes don't happen when everyone is fearful. They happen when fear is at its lowest and greed is at its peak. Right now, social media is full of posts from first-time investors showing off quick gains. AI-related stocks are being hyped as can't-lose investments. Retail trading activity is surging, reminiscent of the meme stock frenzy of 2021. In this environment, any shock, whether economic, political, or financial, can quickly break confidence. What could trigger the crash? While no one can predict the exact cause, several potential triggers stand out. Earnings disappointment. If major companies fail to meet high expectations, valuations could collapse. 2. Interest rate shock. If inflation spikes again and the Fed is forced to raise rates, high-growth stocks could be hit hard. 3. Credit crisis. Rising defaults on corporate or consumer debt could freeze lending. 4. Geopolitical event. War, sanctions, or major trade disruptions could damage global growth. 5. Loss of AI hype. If AI adoption or monetization is slower than expected, the tech sector could deflate rapidly. What a 40–50% drop would mean? A 50% drop in the S&P 500 would take it from over 5,000 points to around 300. Retirement accounts, 401ks and IRAs could lose half their value. Housing market, credit tightening could cause home prices to fall. Unemployment, corporate earnings declines could lead to mass layoffs. Investor sentiment, panic selling could push markets even lower temporarily. How to protect yourself. This is not about panic, it's about preparation. Diversify. Spread investments across stocks, bonds, cash, and potentially precious metals. Reduce leverage. Pay down margin loans and high-interest debt. Increase liquidity. Keep an emergency cash reserve. Focus on quality. Own businesses with strong balance sheets, real cash flow, and essential products. Avoid hype. Don't chase stocks purely because they're trending. Final warning, the signs are here. Extreme valuations. Heavy insider selling. Record debt. A handful of stocks carrying the market. Legendary investors quietly moving to cash. History doesn't repeat exactly, but it often rhymes. If you ignore the rhyme, you risk repeating the same mistakes that wiped out fortunes in the past. The question is not if the market will correct, it's when. Are you ready? If this helped you see things differently, drop a comment and we'll answer your questions. Subscribe for more honest finance content, and remember, smart money doesn't sit, it moves.